Imagine this. You're a seasoned gold trader, seen it all, right? Markets up, markets down. Then, bam, July 31st hits, and it's not the usual news. It's something from way out of left field. A customs office in D.C., not a bank, not an economic report, but something about how they define, well, screwy gold.
Yeah, it's a fascinating, almost textbook example of how these sort of background trade mechanics can just suddenly explode into the foreground. It really turns everything upside down, you know? It's about the actual physical metal moving around the globe.
Exactly. And that's what we're digging into today, this completely unexpected move, what it means, the ripples it's causing. We want you to understand what this seemingly small detail tells us about how global trade and finance will actually work. So let's unpack it. The first shockwave was this quiet change from U.S. Customs and Border Protection, CBP. They reclassified certain gold bars. And the immediate kind of jaw-dropping result, gold bars coming in from Switzerland could suddenly face, get this, almost a 40% import tax, just land like a ton of bricks.
Oh, the reaction was instantaneous. You saw gold prices in New York just spike, hitting levels we really haven't seen. Swiss refiners, they basically slammed on the brakes, stopped shipments to the U.S., completely blindsided. And traders everywhere were just scrambling, trying to figure out, okay, what does this mean? It was, let's just say, chaos for a usually very orderly market.
Chaos is the word. And if you're wondering why some obscure customs rule caused such a panic, well, the details matter here a lot. Can you break down the technical side for us? What exactly did CBP change?
Sure. And this is where it gets, well, surprisingly critical. CBP decided that specific gold bars, the 1 kilo and the 100-ounce ones, if they're investment grade 0.995 pure or higher, they now fall under a different code. It's HTS US 7108.13.55.00. Now, HTS US, that's the harmonized tariff schedule of the US. Think of it like a giant catalog of everything imported, each with its own tax rate. And CBP, well, they're the ones enforcing it.
And this wasn't just, like, moving a comma, was it? This code change had real teeth.
Oh, absolutely. It's the legal trigger. Before this, most investment gold came into the U.S. duty-free, zero tariff. But this specific HTS US code, because of existing trade rules and how they interact with Switzerland, it triggers what's called a reciprocal tariff. And for Switzerland, that rate jumps to around 39%. So yeah, from 0 to almost 40% overnight. It's a huge shift.
Okay, so 0 to 40% is massive.
Yeah.
But why these specific bars, the 1 kilo, the 100-ounce, why aren't we talking about all gold getting hit?
That's a really important question. It gets right to the core of how the physical market works, especially in the U.S. These two sizes, they aren't just random weights. They are the standard, the required size for settling contracts on COMEX. And COMEX, as you know, is the main gold futures exchange right here in the States.
Right, COMEX, part of the CME group in New York. People trade contracts, but crucially, if you hold that contract to expiry, you either have to deliver or take delivery of real physical gold.
Yeah.
And it has to meet COMEX's exact specifications, which means
those exact 1 kilo and 100-ounce bars we're talking about. And this ties directly into Switzerland's role. Switzerland isn't just a refiner, it's the world's refiner. They process something like 2/3 of all gold globally. It's staggering. Now, London usually deals in those big 400-ounce bars, the good delivery bars. What Swiss refiners often do is melt those down or refine new gold, specifically into the 1 kilo and 100-ounce sizes needed for markets like the U.S. for COMEX.
So it's the world's biggest refiner making the specific product needed for the biggest U.S. exchange. You slap a 39% tariff right on that specific flow. You're not just adding cost, you're hitting the main artery supplying physical gold for U.S. future settlement. The delivery cost just explodes.
Precisely. And the market reacted exactly as you'd expect. COMEX gold futures went wild, briefly shot over $3,500 an ounce. Traders were immediately pricing in that higher cost of getting physical metal into the system. It was very rapid adjustment.
And you also saw that gap widen, right? The difference between the New York price and the London price.
Dramatically. That spread blew out, which is a sign the market isn't functioning efficiently, that arbitrage isn't working. And as you mentioned, the Swiss refiners just stopped shipping. Understandably, they needed clarity before sending gold into a potential 40% tax situation.
Right, just hit pause on the whole thing, which obviously got attention.
It did. It got enough attention that the White House actually had to step in. They put out statements saying they'd clarify things, address misinformation, and that did calm the market down a bit, pulled prices off those absolute highs. But, and this is key, the underlying uncertainty. It hasn't completely vanished. It's still lingering.
And this isn't just a market headache anymore, is it? It's kicked off a real debate back in Switzerland, and it's become political.
Oh, definitely. You have the refiners making their case pretty strongly. They're basically saying, look, we only make these kilo and 100-ounce bars for the U.S. because COMEX demands them. It's not some scheme. It's just meeting specific market requirements. Pure supply and demand.
But the politicians aren't all on the same page over there.
No, you're seeing different camps forming. Some are pushing hard for talks with the U.S., trying to get a specific exemption for this investment-grade gold. They argue it's more like a financial asset, not a typical manufactured good that should face tariffs. But then you have others saying, well, hang on, the gold sector is very profitable. Maybe they just need to absorb this cost if the tariff sticks. Treat it like the cost of doing business.
And we need to remember the scale here. Switzerland doing 2/3 of global refining. Any disruption there isn't just local.
Exactly. It echoes globally. It affects supply chains, pricing, liquidity everywhere. Miners, other trading hubs, investors, central banks, everyone feels it when the Swiss hub is disrupted.
So beyond the immediate price spikes and pauses, what are the deeper, maybe less obvious consequences here? How does this change the way the gold market actually works?
Well, it sets off a kind of chain reaction. First, obviously, import costs go way up for that specific, crucial type of gold needed for COMEX. That's straightforward. Second, you get these persistent price differences, these spreads between New York and London. The market isn't unified like it usually is.
Which makes just getting the physical gold for delivery riskier and more expensive too, right?
Absolutely. The cost and complexity of settling those futures contracts physically just increase significantly. And that directly impacts arbitrage. You know, the traders who normally smooth out tiny price differences between markets, that 39% tariff just obliterates their potential profit. So that essential market balancing mechanism, it breaks down between NY and London for these bars.
So the economic gravity holding prices together gets weaker. That's a good way to put it. And longer term. This could actually force some big structural shifts. You might see refiners think, okay, maybe we need to set up some refining inside the U.S. to avoid this, or maybe shift more production to places without these tariffs, like the UAE or Singapore, which are growing their refining capacity. You could even see attempts to route gold through third countries to mask the Swiss origin, adding complexity and, frankly, more cost. This could redraw parts of the gold map.
That sounds pretty fundamental. So looking forward, what are the ways this could play out? What are the main scenarios we should be thinking about?
Broadly, I see three main paths. First, the optimistic one. Quick clarification. CBP or the White House comes out and says, okay, wait, this tariff doesn't apply to investment-grade gold like this. Problem solved mostly. Market breathes a sigh of relief.
Okay, scenario 2. Scenario 2 is maybe a partial tariff. Perhaps it sticks, but only for certain bar sizes, or maybe it's applied differently depending on the country. Not a full reversal, but not the current situation either. Prices would adjust, and you might maybe see a small incentive for more U.S.-based refining develop over time.
And the third, potentially most disruptive scenario.
That's the full tariff stays. The ruling stands as is, applied broadly. If that happens, you're looking at a long-term change in how gold flows globally. You'd likely see a permanent premium for gold in the U.S. compared to elsewhere, and it could seriously impact liquidity for COMEX delivery, making it harder and more expensive to source the physical metal needed. That could change COMEX's role.
Okay, so for listeners trying to track this, what are the key signals? What should they be watching in the next few weeks or months?
All right, 5 things to keep a sharp eye on. 1, any official updates or rulings from CBP itself. That's number 1. 2, COMEX registered stocks. That's the gold sitting in their vaults ready for delivery. If that number keeps dropping, it signals supply issues. 3, that New York versus London gold price spread. If it narrows significantly and stays narrow, that's a good sign things are normalizing. 4, ETF flows. Watch the big gold ETFs like GLD, IAU. Big inflows or outflows can tell you about broader investor sentiment and physical demand shifts. And finally, 5, any news about actual talks, political discussions between the Swiss and U.S. governments. That's where a resolution might come from.
Got it. So pulling this together, what does it mean for different people in the market right now? If you're, say, a short-term trader.
Expect more bumps. Volatility is likely to stick around until there's real clarity. Markets hate this kind of uncertainty.
And for someone buying physical gold, especially those kilo bars from Switzerland,
definitely double check with your dealer. Be prepared for potential delays and, potentially higher costs. This tariff isn't just theory. It could hit your wallet directly.
And zooming out for the long-term gold investor.
Look, this might just be a short-term blip in gold's long history, but it's a really powerful reminder, isn't it? A reminder that gold prices aren't just about mining, inflation, or interest rates. They're also deeply connected to geopolitics, specific regulations, and the often hidden plumbing of global trade, how things actually move.
It really is quite something. A single customs ruling in Washington sends shockwaves through refineries in Switzerland, trading desks in London, vaults in New York.
It really forces you to think about where risk comes from in this interconnected world. It's not always where you expect it.
Absolutely. So whether this whole thing fades away quickly or leads to lasting change, maybe the question for you, the listener, is what does this reveal about those hidden mechanics? In the gold market, it seems the really big shift can start quietly, far from the price charts, deep in the rules about how metal moves around the planet. Something to think about. And finally, just a crucial reminder for everyone listening. We are not certified financial advisors. This content is purely for educational and informational purposes. If you're thinking about making any investment decisions, please consult with a certified financial advisor first.